welcome everybody. Thank you for attending today. Welcome to the Devonshires webinar on leasehold reform, what has happened and what may be to come. Just by way of introduction, my name is Jatinder and I'm one of the lawyers in the housing management and property litigation team at Devonshires. And with me today, I have Lina Amir, who is a solicitor in the same team, HMPL. And so if we just obviously crack on to the next slide, Lina. We're going to look at, and first of all, I think it's important to kind of look at why leasehold reform has come into play and review what's happened to push this reform forward and why it was considered to be needed. So in terms of leasehold reform, it has been on the government agenda since 2017, the white paper being Fixing Our Broken Housing Market, which included a commitment to improve consumer choice and fairness in leasehold. The white paper also stated that the government wanted to promote transparency within the area. And within that white paper, it identified issues with the leasehold model, including the ground rent scandal and unfair lease terms. And Lina's going to be touching upon this in a bit more detail later. But broadly speaking, this was brought into the spotlight in 2017, when well-known developers incorporated clauses into leases that obliged owners to pay increase in ground rent at sometimes double the amount. And the Competition Markets Authority became involved to provide guidance to them. Other identified issues include difficulties with the right to manage and enfranchisement, and lack of transparency in service charges, and the use of leasehold for new build houses. Next slide. So the leasehold reform was included in the Law Commission's 13th programme of law reform. It produced a number of papers and reports in 2020, the three main being leasehold home ownership, buying your freehold or extending your lease. The second, leasehold home ownership, exercising the right to manage, and reinvigorating common hold, the alternative to leasehold. And the Law Commission report pulled together the findings of the three aforementioned 2020 reports. And they are quoted as saying that there is a growing political consensus that leasehold is not a satisfactory way of owning residential property. Many people have a fundamental objection to leasehold being used as a mechanism for delivering home ownership. And I think the point here is that they argue that the fact that external investors have a financial stake in a person's home creates an imbalance or an unfair starting point for home ownership. And they go on to say, too often leaseholders, particularly in new build properties, have been treated by developers, freeholders and managing agents, not as homeowners or customers, but as a source of a steady profit. And the balance of power in existing leases, legislation and public policy is too heavily weighted against leaseholders, and this must change. There are also criticisms of specific aspects of how the leasehold market operated, and concerns have been raised in relation to the following specifically within the Law Commission report. The first being legal, practical and financial obstacles for leaseholders seeking to exercise their statutory rights to manage or enfranchise. Then high and escalating onerous ground rents. Again, we revert back to the scandal at that point. 3, houses being sold on a leasehold basis for no apparent reason other than for developers to extract a profit from owning the freehold. The absence of any compulsory regulation of managing agents. Excessive service charges, legal fees or permission fees levied by landlords. And finally, the legal entitlement of landlords to forfeit, i.e. terminate a lease if the leaseholder breaches a term of the lease. At this juncture, we're going to take a very little detour, and I want to touch briefly on building safety. And whilst, as it says on the slide, it's outside the scope of this session, and very much a webinar of its own for a couple of hours at the very least. The primary point here, it overtook the government's kind of agenda, really. The Building Safety Act was brought into force and received royal assent on the 28th of April 2022, and it contains far-reaching provisions affecting recovery of service charges. And on that point, just very, very briefly, service charges cannot be passed on to leaseholders in qualifying buildings in relation to relevant defects. A relevant defect within the Act was defined as anything done or not done, or used or not used at the time of construction or refurbishment, which leads to a risk of 1, spread of fire, or 2, the collapse of the building, in either case such that it would be a danger to people living within the building. As it says here, it's very much a case of something to be aware of, and it's going to be a developing kind of process given how new the Act is. Next slide, please. So now we look at going back to the Leasehold Reform and the government approach to it. In January 2021, Robert Jenrick announced there's the most significant set of reforms to how we hold property for at least 40 years, and the beginning of even more fundamental change to English property law. It was stated that leasehold reform would be tackled through 2 pieces of legislation in the current Parliament. So it's important to look at where we are now and look at further what the government approach is. So the government, in pursuing leasehold reform, looked at the following ways of doing so. And one of the first ways was the introduction of the new model form of shared ownership lease. Second is reduction of ground rent to a peppercorn for new residential long leases. Extending the rights to manage and enfranchise. Changes to the lease extension process, and promoting common hold as an alternative to leasehold. So that is broadly what the government's approach was. So in looking to see what they've actually carried out so far, the first is the introduction of the new model shared ownership leases for houses and flats, which was introduced in 2021. And it'll be something that I look upon in a bit more detail in a couple of slides' time. The second is the enactment of the Leasehold Reform Ground Rent Act 2022, which is due to come in force at the end of June, and Lina will be exploring that in more detail to come. And consultation on extending right to manage and right to enfranchisement. What may be to come, so what is in the offing? Well, the first is changes to lease extensions. The second is the rebirth of common hold as an alternative to leasehold. And the third is regulation of property agents. So if we look at the new model form of shared ownership lease, this new model lease is compulsory for homes delivered via the 2021-2026 Homes England funding programme. It will also apply to homes funded via Section 106 contributions. And importantly, there'll be a transition period to ensure developments already progressing through the planning process are not adversely affected. And as part of it, there'll be one form of lease for flats and another for houses. And what we're going to look into now is a bit more detail of what is contained within the new model form of shared ownership lease. And the first is the right of first refusal for a period reduced from 8 to 4 weeks. So looking at the practical impact of this, housing associations will need to make sure that your internal processes are suitably adapted to be able to reflect the shorter time frame that is now in place. The minimum initial equity share is reduced from 25% to 10%. And this is quite a significant reduction, actually, because whilst it will allow for more affordable shared ownership properties because of the lower deposits and lower outlay at the outset, it could also have a potential negative impact on registered providers and housing associations' revenue streams when selling homes, because you're essentially recovering less money up front. We also then have the minimum standard staircase in equity share reduced from 10% to 5%, and then 1% for 15 years for properties purchased via right to shared ownership. So if we just break that down in two parts there, staircasing generally, if a shared owner wants to acquire more than a 1% share, it can essentially staircase at any time in the same manner as was permitted under the previous model lease. Except now the staircasing can be by way of increments of 5% rather than the previous 10% under the previous model lease. In relation to the 1% staircasing, shared owners can staircase up in 1% increments, limited to the first 15 years of the lease. And I think it's important to note at that stage that it's almost akin to a use it or lose it principle, because if that 1% is not utilized in that 1 year, it cannot be rolled over or carried over to the next year. Again, looking at a practical on a practical level for registered providers, is that when you are faced with a 1% staircasing application, you are unable to charge any administration fee when dealing with those application fees. So, you know, on the face of it, we can potentially see issues here and potential burdens on housing associations and additional costs in having to kind of implement these applications. But again, only time will tell, and it's something that we'll probably start seeing sooner rather than later, given that it's been in play for approximately a year now. The last point on this slide is the minimum lease term is 990 years, and it's a welcome change for shared owners, I think, as it will save them from having to extend their leases soon after a grant. So it's very much a positive impact for them. Next slide, please. And I think I've probably arguably left the most important or probably most widely questioned part of the new model form of shared ownership lease in this last slide. And it focuses on the initial repair period. The landlord is essentially responsible for all external structural repairs for flats and houses for 10 years from the date of the lease, or if shorter, until final staircasing. And this is at no cost to the shared owner, meaning there can be no recovery by way of the service charge. So again, breaking this down, if a shared owner staircases up to 100%, the initial repair period falls away automatically. If the landlord, for example, claims under any warranties, whether that be NHBC or otherwise, then any excess that they have to pay or administration fees levied by implementing the warranty cannot be charged back to the tenant. So again, this is another cost to registered providers. Breaking down what this means, again, on a practical level, looking at the definition of external and structural repairs. It excludes normal general maintenance, redecoration, and renewal work. So the positive is that certain costs can still be charged via the service charge, but care needs to be taken to separate these properly. And again, the practical impact is, once again, unfortunately for RPs, and I'm sure you'll be jumping for joy for this, is that it seems that there's going to be more of an administrative burden and headache, especially where you have sites where there are mixed tenures and shared owners staircasing up to 100% within those units. So you're going to have those calculations looked at carefully. Theoretically, one would hope that following this, you'd look to potentially see a reduction in service charge arrears or disputes, and potentially fewer Section 20A consultations. But I think we can all probably appreciate theory and practice are two very different animals. So again, it's a wait and see on that one. Moving on to internal non-structural repairs allowance. So this is up to £500 per year financial contributions from the registered provider for the first 10 years. And it's for certain other defined repairs, including installations for the supply of water, gas and electricity, and space and water heating. So I think here is, provided that the registered provider, acting reasonably, assesses in advance of such works being carried out that they are essential and genuine. And that's a key phrase here, essential and genuine. Also, importantly, which are the shared owner's responsibility under the lease, and not as a result of the shared owner breaching the terms of the lease. The shared owner is able to apply to the registered provider for this £500 allowance. So putting on my litigation hat, as I have to do, one of the kind of primary points that has come to us so far is whether you are able to kind of, or who is going to monitor the decisions that are made as to whether they are essential or genuine. Government guidance has suggested that it is on the landlord, but where I spoke about that theoretical reduction in claims, this may well balance out that reduction when leaseholders potentially look to challenge the decisions of the housing association. So again, it's something to look out for and something to consider in due course. And the final point here is in relation to reserve and sinking funds. They cannot be used for any external or structural works within the initial repair period, because obviously that is the responsibility of the landlord. So I had a question in advance of the seminar about this, which I'll touch upon a little bit later. But for the moment, that concludes my element of these slides. So I will hand over to Lina to take us on to the removal of ground rent.
All right, lovely. Thank you very much, Jat. As Jat mentioned, I'll be covering sort of some updates on ground rent, the right to manage and enfranchise, lease extensions, and common hold. So to start off, so the question is, why was action on ground rent deemed necessary? As Jat mentioned earlier, and as you may or may not have heard of, the ground rent scandal, which was otherwise known as the Leasehold scandal, it basically brought to light that a lot of developers were including provisions in their lease which allowed them to double ground rent, as was mentioned earlier, and in some cases every 10 years, which effectively made it very difficult for leaseholders to try to sell their leasehold interest, just because the ground rents would be growing exponentially and making it very unattractive for potential buyers. So this led to increased scrutiny on the charging of ground rent, which, as we know, it only really serves as an income stream for the freeholder, as no service is provided in exchange for ground rent. So the Leasehold Reform and Ground Rent Act was enacted on the 8th of February. It comes into force on the 30th of June, and essentially it means that no ground rents can be charged in new residential long leases, and ground rent can only be set as a peppercorn token rent. Landlords won't be able to get around that by charging any sort of admin charges. It has to be a peppercorn rent, which isn't of any financial value. When we say long leases, we're referring to any lease with a term of more than 21 years, which is granted for a premium. There are very few exceptions to the rule on sort of the abolition of ground rent, and that all applies to like business leases, home finance plans, and shared ownership leases, in which you can still, as a landlord, charge rent on the on your own share, so as a housing association, but rent on the tenant's share will have to be reduced to a peppercorn. So if the landlord does receive a prohibited rent, they will have to refund it back to the leaseholder within 28 days of the date that they received it. So they can't keep it, they can't charge it, and if they do, action can be taken by trading standards, the leaseholder or the council, and the breach can result in a fine between £500 up to £30,000. So it's very important to be mindful, especially if you're a landlord who deals with sort of mixed blocks, to make sure that you're only charging ground rent on leases where it's still applicable. So the government announced that the Ground Rent Act would come into force on the 30th of June, and from that date, it's important just to emphasise that no new residential leaseholders will be able to be charged a ground rent. So the question then is, what happens with existing leases that have problematic ground rent provisions? So the Competition and Markets Authority carried out an investigation and found that ground rent was considered an unfair practice where it was being charged at sort of exponential rates. And they entered into agreements with various developers, which required them to reduce the ground rent to levels that they were at when the lease was first entered into. In some cases, they agreed for ground rent provisions to not rely on the ground rent provisions that were in current leases. And in other cases, they've been encouraged to vary leases at their own cost. So looking at the right to manage and to franchise, so the right to manage refers to the process by which leaseholders exercise their statutory right to take over management and control of their own property from the landlord, and they would do this by setting up a right to manage company. So that's done without buying any of the freehold, whereas with collective enfranchisement, that's the right for the owners of flats within a building to buy the freehold together or parts of the building. So government consultation took place on the 11th of January through to 22nd of February about extending and improving those statutory rights. We're still waiting for a response on that consultation, which finished in February, but proposals included sort of increasing the non-residential floor space limit from 25% to 50%, which basically means that leaseholders should be able to buy the freehold even when even when up to 50% of the building is commercial space. So it also allows for the leaseholders to require that landlords take leases for non-participating units after enfranchisement, and there are also changes which are being proposed to voting rights in right to manage companies. So leaseholders currently have a statutory right to extend their leases by 90 years with zero ground rent in exchange for payment of a premium. In January 2021, the government proposed changes to lease extension, and these proposals included increasing the statutory extension from 90 years to 990 years, abolishing the marriage value, which refers to the increase in the value of the property following completion of a lease extension, and which reflects the additional market value of the longer lease. Other proposals were to include a statutory calculation to determine the value of a premium payable, and that was with a view to reducing the premium, and also to provide an online calculator to simplify the assessment of the premium. So coming on to common hold, I have to say that I didn't know what this was until only a few years ago, when I was having a conversation with an Eastern European friend who had no idea what leasehold interest meant, because that wasn't something he was familiar with. But essentially, it's the freehold ownership of sort of multiple homeowners collectively owning their own building, and which enables them to have shared control and responsibility. Unlike in leasehold properties, there's no limit on how long you can own the property for as a unit holder, and this has actually been around since the Common Hold and Reform Act of 2022, but it's not been taken up very much. So in terms of looking at common hold as an alternative to leasehold, the Law Commission recommended promoting it as an alternative form of home ownership, and the Common Hold Council was set up in 2021, which consists of a panel of industry experts and leasehold groups, which advise the government on preparing the housing market for increased use of common hold. I think there are only about 15 to 20 cases of common hold properties at the moment. So the government is still considering the Law Commission's recommendations. And as you can probably appreciate, there's perhaps some tension between the move towards, the push towards common hold and moving away from leasehold, whilst continuing to use the shared ownership model, which relies to some extent on the involvement of the freeholder. So looking forward and thinking about the impact of common hold will of course fundamentally change the way that blocks are managed, and they will give more control to owners of the common hold interest. There will be an impact in terms of the control that social landlords have on parts of their own stock, and it will clearly impact future management and ability to develop blocks in the future. And so the government is likely to have to give a bit more thought to how to incentivise the use of common hold and make it more attractive to developers. In terms of timeframes for future reform, the House of Lords did indicate that we are likely to see some wide leasehold reform within potentially the next year. And that brings us on to the Queen's speech, which was delivered on the 10th of May, and which set out the government's proposed legislative changes. And again, it sort of reiterated what we can expect future legislation to be looking at. And as we've discussed during this webinar, we can expect legislation to be looking at banning new leasehold houses, so that all new houses are freehold from the outset rather than only in exceptional circumstances. Making it easier and cheaper for leaseholders to extend their lease or to buy their freehold. Making it simpler and quicker for leaseholders to take control of the management of their building, and better protecting and empowering leaseholders by giving them more information on what their costs cover, ensuring that they're not subject to any unjustified legal costs, and that they can claim their own costs, legal costs, from their landlord, and also to deliver a reformed common hold system as an alternative to leasehold ownership. So we are expecting a lot more information and a lot more detail to be published, and we will keep an eye out on those developments and keep you updated by way of webinar and articles. So we've come on to questions.
Yeah. Thank you, Lina. That was excellent. Really, really informative. So thank you very much for that. We have had, as I said at the outset, a number of questions and an evolving one as well. And one of the questions that came through was this: can the £500 internal allowance roll over for the full 10-year period? So in effect, the question I think is driving that is at the end of the 10-year period, the shared owner has basically a pot of £5,000 for repairs, and the short answer for that is no. It doesn't roll over for the full 10-year period. If the shared owner does not claim the full allowance in 1 year, only a maximum of 1 year's allowance will roll over to the following year. So basically, at any given point, there will only be a maximum of £1,000 at any given point. I should also say that arising from that, one of the practical implications is that the shared owner must use a trust marked approved tradesperson or professional approved by the landlord. And then finally, that if the leaseholder, if the shared owner sells the home, the repairs allowance will usually transfer to the new owner. But if the new owner buys 100% share, then they are not entitled to the repairs allowance at all. And Lynn, just whilst you're looking through the questions that have come in, I've just got another one that I'll tackle. Another question is, are we allowed to charge a sinking fund from day one to be used after the period of year 10? So my view, yes, that is correct. It can be collected from day one, but it's important to remember that whilst it can be collected, a sinking fund cannot be used for any external structure within the initial repair 10-year period. So I think to give a very, very basic example of this, so there's a 25-year period. The first 10 years are within the initial repair period. So you can only charge for a 15-year timescale, which is after the initial 10 years. So you can spread that 15-year period of estimated costs to go into the sinking fund over the course of the 25-year period, and then you can use it once the initial 10-year period is over. Lina, did you want to tackle a question?
Yes, sure. We've got one about whether the new ground rent rule will apply to RTA or right to buy leases when it comes into force, where I think you've got a £10 annual charge. So again, just to remind, the new rules on ground rent apply to all new long residential leases. So if that right to buy lease it comes into existence after the 30th of June, then you cannot charge any ground rent for it. When it comes to existing leases, you can continue to charge the ground rent on those. And as we mentioned, the Competition and Markets Authority were in discussions with various developers to try to tackle any sort of unfair amounts of ground rent that are being charged. But in the meantime, for existing leases, you can continue to charge the ground rent. It's for any new leases that come into existence after the 30th of June that you won't be able to charge ground rent for. The Act doesn't have any sort of retrospective effect, and it doesn't really do very much to protect existing leaseholders. So yeah, that's that one.
Okay, I've got one in. Does the initial 10-year period pass to a new shared owner if the original purchaser sells within that initial 10-year period? Yeah, really good question. Yes, it will pass to the new buyer, and they are afforded the remainder of what is left of that 10-year period. So they don't benefit from a new 10-year period upon purchase.
Okay, there's a question about lease extensions as well, and I'd just say that with a lease extension, effectively, you're required to sort of surrender the existing lease and then grant a new lease. So the ground rent provisions will apply to that new lease if there is a formal arrangement between the landlord and the leaseholder. Where there isn't a formal arrangement, then you can continue to charge the ground rent under the existing lease. But whenever there's a variation, the period from which it's extended is considered a new lease. So the ground rent will not be payable from the date of the variation.
Another question in, does the £500 allowance cover things like maintenance and decoration? So no, the £500 per year internal non-structural allowance is for essential and genuine works, and they don't cover maintenance, decoration or renewal works. So that potentially is captured under the service charge, which you'll be able to recover. Whilst you're having a look, Lina, I've got an interesting one here, a rather unique one. If a leaseholder has service charge arrears, are we allowed to deduct this from the £500 internal allowance per year? That's a unique question. I think not. I think I don't think the lease would allow or provide for that. And I think fundamentally they are two separate things. You'd have a contractual obligation within the lease to pay the service charge, and if they fail to pay this, then I think you'd have a suitable recourse or right of action by way of a money claim and then potentially possession.
Okay, so I've got one here. So if you have an existing property where the ground rent goes up every 5 years, so it has gone up a few times already, what is the best case scenario? Can the rent be reduced back to the initial charge, and when can that be applied for? So again, if it's an existing lease, you can continue to charge the ground rent. If it has gone up, again, it's still enforceable. In terms of changing it back to what the initial charge was, as you mentioned earlier, the Competition and Markets Authority was in discussions with developers on trying to go back to the initial charge, and that's something that you can potentially approach them for. But as it stands, the ground rent being charged on current leases still is chargeable.
Let's have a look. So one of the first questions as well, 1% at market value, still having to get legal reps involved, is it worth it? Unfortunately, when it comes to staircasing at whatever percentage, there is that requirement, and this is why I spoke about the administrative burden along with the additional costs that would incur. So unfortunately, yes, because it is obviously a change in the amount that they are able to own, then it would be worth, or would still be required to get legal reps involved. Another one, Lina, unless you wanted to have one, I can.
Just a quick one here. So might common hold become compulsory for new development? I have to say, I don't think it will. I mean, at the moment, there's a lot of discussion around trying to encourage common hold. And I think there probably needs to be a lot more in terms of incentives in place, because at the moment, I think the ground rent provisions were a huge incentive for developers to build and to sell interests in their buildings by way of leasehold. So I think there does need to be more around incentivizing common hold, and I can't see it becoming compulsory in the immediate future. But we'll watch this space and see how things develop.
Okay. Another question, for a 1% staircasing, the RP can't charge admin fees, but can they still require the leaseholder to obtain a valuation to calculate the premium for the 1%? So the price of the 1% share will be based on the initial purchase price adjusted in line with the house price index. So if there's any dispute as to the value, it can be referred to an independent expert. The HPI valuation, once prepared, will be valid for a period of 3 months, and is stated, and as I explained, whilst providers can't charge an admin fees when at least a staircase is at this 1% level, both parties must pay their own costs. Essentially, they bear their own costs, and so if they do have their own valuation on that amount, then they would have to bear the costs of that. One other one, when does the 10-year period start? The initial repair period from construction or date of purchase? So within this new model leases, it introduces obviously the 10-year period from the date of the lease, and while the home remains a shared ownership home. So it is from the date of when the lease is entered into, date from purchase.
Okay, so I've got one here. Would ground rent on current leases be chargeable upon assignment or selling of that lease? I understand you've mentioned lease extension variation as a new lease, but an assignment would remain an existing lease. Am I right? I think you are. I think the provisions around an existing lease would be that you can continue to charge, and where you vary the lease, where there is a formal variation of the lease, that then becomes a new lease, and so ground rent is no longer chargeable. But for an existing lease which is sold on, it's still an existing lease, and the provisions that are currently in that lease are still applicable, and therefore a ground rent would still be chargeable on an existing lease.
Okey-doke. Will there be a cap on how many times a shared owner can staircase? Think that the increments are too low. So within that one, if I focus on that 1% increase that I discussed, it's limited for a period of 15 years, and it is for a period of that 1% can only be utilized each year. So if for example you don't use it on year 3, but you want to do it on year 4, you can't essentially utilize the 2 years together. Once that year is finished, it is capped and you lose it. And then you move on to the next year where you can increase up to that 1% the following year.
We've got a question here on can a group of leaseholders change from leasehold to common hold as an alternative to collective enfranchisement, or would common hold only be applicable to new properties? There isn't a lot of information about how common hold will be rolled out, more so than it is already. But I think you can convert from leasehold to common hold as long as the leaseholders are in agreement with doing that. But I think more information, as I say, should come out about that. But I think that will be a possibility.
So I could see we've got a huge amount of questions flowing through, and it was very much expected to be the case, given, as I said at the start, at the outset of it, that there would be so many questions, given that it's so new, and with the new Act coming into force. I think probably given the amount of questions that we've gone through already, would probably look to go through and take stock of some of the questions that have been posed. So I think what we're going to do now, we'll probably conclude the seminar, and we will come back to those who have asked questions and that we haven't got round to answering them yet, and obviously touch base with you. You'll have our details in the slides, so if there is anything you think of afterwards that you kind of just thought, I just want to run it past us, or get our view on it, more than welcome to give us a call or an email. Our details will be on the slides. And all that remains to be said from my end is thank you very much for coming. We've had a very healthy turnout today, so thank you for that. And we look forward to seeing you at future Devonshires webinars, and look out for e-alerts and e-flashes on these topics as they come through.